Hey, good morning, ladies and gentlemen. Welcome. I think it's a real pleasure to have you with us today as we present our operating and financial results for 2025. So thank you very much for joining us today. I think just in terms of the agenda that we've got, I will start off with a few high-level salient points. Then we'll move into the performance excellence, which will be presented by a number of the team. We'll then move into growth and just touch briefly on the resources, the mineral resources and reserves that we've recently published. Charl will take us through the financial performance, and Kleantha touch on how we're interpreting these very volatile markets we're seeing, and a little bit of the outlook in that regard before I wrap up with the way forward. I think there are several forward-looking statements in the document, so would urge you please to just take note of the safe harbor statement. Thank you. I think when we reflect on December 1, 2025, I think certainly during the latter half of the year, it was a time of significant change at Sibanye. We of course had the leadership transition, and with that we also undertook a refresh of our strategy. This was something that we presented to the market at the end of January, but for anybody who was not able to make that, if I could try and summarize our strategic refresh in one word, it would be simplification. Specifically, what we're really focusing on in the short term is around maximizing and driving our operating margins. We're doing that through a keen focus on operational excellence and simplifying the operating model that we have. And then further simplification through our portfolio, such that we're focusing on the highest return assets, of course, cash generative assets, and ensuring appropriate management focus in that regard. This is all coupled with a very disciplined capital allocation framework, which we shared as being roughly a third towards shareholder returns, a third towards reducing our gross debt, and a third towards growth. And again, Charl will unpack that in a little bit more detail. And in terms of growth, we certainly see the best value at the moment for us in terms of returns as being internal, in terms of the resource value that we have. We have a significant resource base, particularly in South Africa at our PGM operations, and organic growth will be our immediate focus. But we did also share a value creation framework that we have put together that will help us assess any external growth opportunities moving forward. In addition to the strategic refresh, I think there were some quite key decisions that we needed to make towards the end of last year, especially amongst several of our operations. One of the big ones was the startup of the Keliber lithium project in Finland. That is a greenfields project that we have built, and given the volatility in the lithium market, we had to make a decision how best to proceed with that project. And I think very pleasingly, towards the end of last year, together with our partners, the Finnish Minerals Group, came to a way forward which really considers a staged ramp-up of the Keliber project. And we'll share a bit more of those details with you in the presentation, but it really is an approach that mitigates some of the risk of the market, while allowing us a lot of strategic optionality around the project. And we'll unpack that for you in the coming slides. A second big decision we had to make was around Kloof. We did share with the market that early on in the year, due to increased risk of seismicity and what we deemed to be an unacceptable safety risk, we ceased mining at quite a few of the deeper level areas at Kloof. And this had a material impact not only on the output from the Kloof operations, but also the future of that operation. Towards the end of last year, we did make a decision that Kloof would continue to operate on a year-by-year basis, assessing the profitability each year as we proceed. So very dependent on sustained higher gold prices. And then there were several priority projects that we have been evaluating during the year, and we'll be making financial investment decisions on during the course of this year. There was also some overhangs from previous or legacy issues. We had to address the Appian court case. We came to a settlement there in November, ultimately a settlement payment of $215 million. And then we also had the South African gold wage negotiations that had been continuing from about the middle of the year And I think credit to the team, we successfully settled that also towards the end of the year. And again, credit to all stakeholders. I think a very good outcome considering the environment we're currently operating in. But I share this because I guess it was a rather busy, a transformational, and actually quite a noisy second half of the year, with lots of decisions being made in terms of how we will continue going forward. And that has also reflected in our finances, which are complex, and again, I dare say a lot of noise. But hopefully, certainly the way I feel, and hopefully you can see that what this has done is simplified our operations going forward. It's already simplified where our focus needs to be, and I think it's set up a solid operational base, which we have launched into 2026. And I look forward to that simplification also starting to feature in the financial numbers as we ultimately simplify the total portfolio. I think looking at our operational output, safety, and I'll unpack safety in a bit more detail in a coming slide, but very pleased with the continuous improvements that we've seen in many of our indicators, both lagging and leading indicators. We have seen some of our best numbers ever, which is pleasing in terms of the progress that we've made over the years. But our focus on eliminating fatals remains our absolute priority as a company. I think I have to give full credit to many of our operational teams. As I say, this was a busy period. It was a very volatile period in the markets, and yet our operational teams delivered solidly across most of our business. All of our operations came in largely within guidance, recognizing we did have to revise guidance at the gold operations because of the Kloof decision I mentioned earlier. But to have come in within guidance or better than guidance across the board was very pleasing, and full credit to our teams in that regard. We also made some great strides on our sustainability strategy across many aspects, including water, including the social investments in South Africa. But one that really is a bit of a standout is our positioning with regards to our renewable energy, where I think we really are now positioned as a leader in renewable energy in South African mining. And certainly that is not only going to have a material impact on our carbon footprint going forward and our ability to provide responsible metals, but also a significant commercial benefit. Just during the year to date, on a small portion of the projects we've commissioned, we've already achieved close on 100 million rand worth of savings and avoided over 300,000 tons of carbon dioxide. And we see that going up to close on 1 billion rands worth of savings over the coming years. Like I mentioned, I think with much of the decisions and complexity we had in the business over the second half of the year, that does reflect in our numbers. But looking through those numbers, I guess sort of really through to the core financials, I think what we really see is stability, a real turnaround, and I think a solid base of which to build into 2026. We achieved the highest EBITDA that we have in 3 years at just under 38 billion, or just over $2 billion. And to see a headline earnings per share up by just under 300%, I think is very pleasing, particularly given that most of that just came during the second half of the year. Our balance sheet remains strong. Our total net debt to adjusted EBITDA has declined to below 0.6 times, so very comfortably within covenant limits. But as we shared during our strategy, renewed focus on gross debt to ensure stability through a cycle, is where our focus will be going forward. But overall, with the good operational output, with the strong financial stability and underpinned, I think as a company and a board, the board is very comfortable to declare a dividend of 131 cents per share. That equates to roughly a 2% dividend yield. And again, I think reflecting largely just the earnings over the second half of the year. And that dividend declaration is at the top end of our dividend policy. So very glad to be back into dividend paying territory. I think as we look at performance excellence, we did share at the end of January during our strategic update that our strategy is based on 4 pillars. Simplification, I've mentioned already, simplification of how we operate, driving accountability, simplification of our portfolio, getting our focus and capital allocation in the right place. And the second pillar was performance excellence. Performance excellence is really covers a holistic improvement, and within there we have safe production, we have the operational excellence, which I think will be well understood by many, resource optimization, how best we can extract our resources, maximizing long-term economic value, and of course embedding sustainability in the way we operate. And for us, sustainability is really about people, the planet, and prosperity for both. I will specifically touch today on safe production and then hand over to the two COOs, Richard and Charles, to look at operational excellence, and Melanie on sustainability. So I think touching on safe production, as I mentioned earlier, it's been extremely pleasing to see the trend that we have seen since 2021 in particular, and I raised 2021 because that's the time when we started our fatal elimination strategy. Since then, we've seen over a 40% reduction in serious injuries, and the reason we look at serious injuries is that is very often associated with high energy incidents. So high energy incidents that could result in either fatal incidents or certainly life-changing incidents. I think we've also seen a similar pleasing decline in terms of the high potential incidents that we measure. Some of those are associated with injuries, some not. But it certainly gives us a good data point to understand whether or not we are decreasing risk within our operations, and whether we look at our own history, whether we benchmark ourselves against peers who have similar underground, narrow tabular, labor-intensive operations. Generally across the board, I think we've seen a significant reduction in risk in our operations, and that is a trend we'd like to see continue. And we continue to benchmark ourselves against ICMM peers, many of whom, of course, operate in very different environments. I think what's always tough talking about these safety trends is as pleasing as it is to look in the rearview mirror and understand that we're doing the right things to reduce risk. As a management team, we also recognize that is unfortunately very cold comfort to family and friends of colleagues who we have lost on our operations. And tragically, during 2025, we did experience 6 fatal incidents across our operations. And in this regard, I would really like to extend our heartfelt condolences on behalf of the management team and the board to the family and the friends of Humberto Xavier, Umkazi Jozana, Nomsa Matsolo, Brian Hansen, Asiswe Ramalia, and Klaas Nkosana. Eliminating fatal incidents is absolutely our number one priority as a board, as a management team, and as a company. Our focus moving forward into 2026 remains on how we can more effectively embed our fatal elimination strategy. The strategy fundamentally hangs off 3 pillars of critical controls, what we call critical management routines, or effectively management practices, and then life-saving behaviors. Those are the 3 key pillars that will mitigate risk within our operations. The focus for 2026 is how we can enhance compliance in this regard, but most importantly, enhancing it through a transformation of culture, which will also drive behavior. I think what we have seen historically within the mining industry is that compliance is driven through force, through instruction, and we recognize the opportunity to change that culture and to drive compliance through a culture of accountability and a culture of care. And through that, we truly believe we will eliminate fatal incidents from our operations. Thank you very much. And with that, I will hand over to Richard Cox to take us through the South African operations. Over to you, Richard. Thank you.
Thanks, Rich. Hello, everyone. As Chief Operating Officer of our South African operations, my focus is on delivering performance excellence through safe production, operational efficiency, and holistic improvement. Our strategy ensures we consistently improve delivery across our portfolio. So let's take a look into our 2025 results for the South African business. Turning to our SA PGM operations, we've maintained consistent delivery, meeting or exceeding guidance each year since 2017. More specifically, for 2025, Total 4E PGM production reached 1.8 million ounces, including attributable production from Mimosa at 117,000 ounces and third-party purchase of concentrate at 73,000 ounces, and all aggregated, aligning with our 1.75 to 1.85 million ounce guidance and stable year on year. Since the Lonmin acquisition in 2019, production has remained steady between 1.73 and 1.83 million ounces annually, reflecting our operational resilience and ongoing progress toward the second quartile of the industry cost curve. Breaking it down, underground production increased 2% to over 1.6 million ounces, supported by improvements at Rustenburg's mechanized Botupele shaft and more stable output compared to 2024's disruptions at Siphumelele and Kroondal operations. At Marikana, output was affected by safety-related stoppages at the high-performing Safi shaft, but this was partially offset by K4's ramp-up, where production rose 41% to almost 100,000 ounces, contributing to Marikana's improved cost position. Surface production was lower by 29% at 108,000 ounces, influenced by high first quarter rainfall and the commencement to transition feed resources, such as Rustenburg's Waterval West TSF and Marikana's ETD1 to ETD2 tailings facilities. We are evaluating long-term surface opportunities at Rustenburg to support the sustainability of the surface business. Purchase of concentrate volumes were reduced by 24% in line with contractual terms. We remain focused on cost discipline. Operating costs increased by just 7.3% in absolute terms. All-in sustaining cost rose 10% to just over 24,000 Rand per 4E ounce, and that was within our 23.5 to 24.5 thousand Rand an ounce guidance, bolstered by byproduct credits of 11.1 billion. Now, these credits were enhanced by stronger ruthenium and iridium contributions, helping offset a 261% increase in royalties to 765 million from higher prices, and a 12% rise in sustaining capital to 2.9 billion for key mining equipment and precious metal refinery infrastructure. Project capital was lower by 16% at 675 million, which was below guidance due to completed Rustenburg initiatives and deferred Marikana expenditures. Total capex came in at 5.9 billion, under our 6.5 billion estimate. So this foundation we are creating enables us to capitalize on stronger PGM prices. The 2025 average 4E basket price increased 28% to over 31,000 Rand per ounce, driving adjusted EBITDA up 125% to 16.7 billion. Early 2026 prices have risen 43% to over 44,000 per ounce, as shown in the chart, following an even higher and brief January adjustment. With supported fundamentals, we anticipate potential for additional earnings and cash flow improvements in 2026. We are continue investing through the cycle in low risk, low capital intensity projects with quick paybacks, all supporting stable, high performing operations with optionality to extend our portfolio. Overall, our SA PGM operations are very well positioned to benefit long term and also from the current market upside. This slide illustrates our advancement on the PGM cost curve and based upon end December 2025 data, and highlights our positioning relative to peers. Starting on the right, Marikana's total cost, including capex, has been influenced by K4's project build-up phase, but as K4 approaches steady state, we're seeing a shift towards lower costs. This combined Rustenburg and Kroondal position has moved slightly higher due to the Kroondal transition to toll treatment, which does introduce processing costs, however, enhances profitability through improved revenue and margins. While we are at or below the 50th percentile now, and our low capital intensity brownfields projects are poised to further strengthen competitiveness against peers, Spot 4E and 6E, which includes base metal basket prices, are positioned well above our costs, underscoring our leverage in the prevailing market. And so our progression from the fourth to the second quartile reflects the value of our strategic investments in building long-term sustainable advantage in this business. Now to our gold operations. These mature assets are highly geared to gold prices and continue to generate strong cash flows in the current supportive price environment. Total production, including DRD gold, was lower by 10% at 19.7 tons. Underground production reduced by 8%, primarily due to operational challenges at our Kloof operations, including seismicity and infrastructure constraints, while surface production was down 16%, influenced by lower yields as we transitioned from higher grade to lower grade tailings and lower grade third-party sources. A 39% increase in the gold price received helped mitigate this impact, though all-in sustaining cost increased 15% to 1.4 million per kilogram, with 14% lower gold sold. At our Kloof operations, persistent challenges, including a shaft incident at our Manano 7 shaft in May of 25, infrastructure age showing in ventilation pass and ore pass systems, logistics constraints and seismic risk in high-grade isolated blocks of ground or RBGs, resulted in production lower by 31% year-on-year at 3,374 kilograms. This prompted a rebasing of the plan and a life of mine adjustment to 1 year. Safety remains our number one priority. We did relocate a number of Kloof teams from higher risk RBGs to Driefontein operations, and subsequently, post a comprehensive review process, removed those areas of Kloof operations from the long-term plan to align with our risk tolerance. That said, the sustained rise in the Rand gold price over the period boosted adjusted EBITDA 115% to 12.5 billion, representing 33% of group EBITDA and surpassing 2020's record. Excluding DRD gold, EBITDA increased to 111% to 6.1 billion on average price of 1.8 million Rand a kilogram. For the whole gold business, we are pleased to have concluded a 3-year wage agreement with Labour, and that provides a degree of cost certainty moving forward. There is a lot of work underway supporting our strategic transitioning of the SA gold business, and this effort is to ensure long-term sustainability. Our investment in DRD gold is a prime example, providing long-life, high-margin surface gold exposure that is cash generative. We are also focusing on a higher margin shallow gold mining business, with Burnstone's feasibility study underway and final investment decision being targeted for the first half of 2026. As you see in the image here, the Burnstone project exemplifies this strategic shift. We are also focusing on high margin shallow gold mining, where we have added over 1 million ounces in reserves at Cook Surface, Burnstone, attributable DRD and Beatrix operations. Turning to the charts, the gearing and all-in sustaining cost margin chart illustrates how rising prices are opening up expanding margins, with the average gold price received climbing steadily against controlled all-in sustaining cost. The adjusted free cash flow bar chart highlights the magnitude and rapid cash flow turnaround, moving from negative in 2024 to positive and significant in 2025. Looking forward, our core operations will continue to drive performance excellence, and we're excited about the prospects in our current portfolio. For 2026, the outlook is positive. Spot prices are up 9% year to date to over 2.5 million Rand per kilogram, and 20% above second half 2025 levels, all boding well for another successful year with potential earnings and cash flow growth. I'll now hand over to Charles.
Thank you, Richard. The US PGM operations have had a solid year with production of 284,000 2E ounces and an all-in sustaining cost of $1,203 an ounce, beating our guidance, combined with a strongly improving safety performance into year-end. The significant downsizing in late 2024, while turning around the cash bleed at the time in the context of depressed prices, also sowed the seeds of improved mining productivities and cost efficiencies that we have built on through the year under review. Certainly with improved PGM prices later in the year, we returned to profitability, and when you overlay Section 45X benefits, you have a competent outcome. During this period of getting our operating performance right, albeit at lower volumes, the team led by Kevin Robertson has also done a significant amount of work on setting up the Montana operations for long-term success. You'll have seen in the earlier global cost curve that we are now sitting in the middle of the pack and have been for 2 consecutive quarters. But our drive towards $1,000 an ounce is aimed at being a lowest quartile PGM producer on a sustainable basis through price cycles. In the Montana operations, we have a legacy of semi-mechanized mining with narrow headings and small stopes, using a range of small equipment such as 2-yard LHDs and CMAC bolting, which ultimately constrains you with lower tons per cycle and a higher cost per ounce, notwithstanding the fact that our miners are incredibly good at what they do and bring significant skills and experience to the process. Through last year, we trialed mechanized bolting with success, and we are right now rolling out a significant transformation program, which will see, amongst many changes, a stepwise introduction of mechanized equipment, a progressive increase in heading size and advance, with associated workforce and supervisory upskilling, and a shift from legacy captive stoping to task mining. The benefits of these changes really start bearing fruit in 2027 because we have a phased introduction of new equipment and changes to work practices running in parallel with our established approach. Where this takes us in the next 18 months is a fully mechanized and scaled operation with higher productivities and lower costs, improved safety and wellness benefits, and a business that we believe will be resilient through price cycles. We are starting these change interventions at Stillwater East and then moving to East Boulder. And once we know that we can deliver around $1,000 an ounce, we will consider bringing back Stillwater West, although this will require infrastructure upgrades and a range of capital spend, which means that we have that decision point further down the road, and it will need to be based on an extensive feasibility study. If I turn to the US-based recycling business, 2025 has also been a busy year for us. We bedded down and integrated the Reldan acquisition, and late year added the Metallics acquisition. Together with our Columbus Autocat recycling business, we believe that we have a compelling PGM and precious metals recycling platform that has low capital intensity and which can provide stable margins through price cycles. The team led by Grant Stewart is moving very quickly to integrate the management teams and optimize which feeds go to which site, while leveraging a single sourcing and sales platform that now has very wide reach, both in the Americas but also into Asia and elsewhere. As investors and analysts will appreciate, there is significant change underway in global metals recycling, where we are seeing consolidation, vertical integration, and indeed some companies in various parts of the value chain going to the wall. Within the significant shifts underway, I think we are well positioned. We know what our value proposition is, the niches that we play in, and which differentiates us against some of our very large competitors. And we now have the ability to organically grow an integrated recycling platform without needing to necessarily chase new acquisitions. Our Century Zinc retreatment business in Australia has also had a very good year, from a stellar safety performance through to increased production of 101 kilotons of payable metal and a 17% decrease in all-in sustaining costs to $1,920 a ton, which exceeded guidance. This team is very ably led by Barry Harris, and I want to thank Robert van Niekerk, who was the executive lead through the last couple of years, for a seamless handover. As you will be aware, the team has been working on 2 feasibility studies, FOS1 and Mount Lyell. The Mount Lyell feasibility study is currently under assurance review and evaluation. We expect to have a close-out review in early May. The FOS1 study is expected to be completed end of March, with assurance targeted to be completed end of May. Final decisions will be made within our disciplined capital allocation framework that Richard has spoken to. Given the remaining short life at Century, a pathway to new opportunities in Australia is important, and I'm looking forward to spending time with the team on the ground next week and working through the opportunity set. With that, let me hand over to Robert. Thank you.
Thank you, Charles, and hello, everybody. Sibanye-Stillwater has a substantial life of mine and a solid project base, focusing only on the precious metals. We've got 356 million ounces in the resource category, of which about 16%, 58.2 million ounces, has been converted into the mineral reserve category. SA PGM operations contribute about 50% of the resource base, 177 million ounces, and again, about 16% of that has been converted into reserves, 29.4 million ounces. If you look on the right-hand side of the slide, you can see that these reserves serve very, very significant operations. Some of the Rustenburg operations have in excess of 32 years life. The Marikana K4 project, for example, has a 45-year life of mine, and the Marikana East 4 project has a 34-year life of mine. As Richard said earlier on, our gold operations are mature. They are leveraged to the gold price, but I would like to add they are very significant. We have a 43 million ounce resource and a 9.4 million ounce reserve. The Beatrix operation in the Free State is a solid operation. The Driefontein operation is a very solid operation. And our DRD operation is a world-class tailings retreatment operation. We also have the Burnstone project, which is destined to become a very efficient, shallow, low-cost, 25-year life of mine operation. The second biggest category of our resource base is our US operations. Here we have 80.9 million ounces in resource, of which only 19.4 million ounces have been converted into reserves. Again, these assets are highly leveraged, they are high grade, they are quality assets. And again, if you look at the right-hand side of the slide, the Stillwater mine has a 26-year life of mine, and the East Boulder mine has in excess of 30 years, actually 35 years life of mine. I would also like to add that this year we have included a maiden reserve for the Marikana East project in the SA PGM region. We have also included a maiden reserve for the Cook TSF and a maiden reserve for the Mount Lyell copper project in Tasmania, Australia. In closing, I'd like to leave everybody on the call with a message that next year, 26 and 2027, Sibanye-Stillwater will be focusing on converting a large percentage of their abundant resources into reserves. With that, I'm going to hand over to Melanie. Thank you very much.
Thank you, Robert. Good morning, good afternoon, and good evening to all attendees. Our renewable energy program remains central to our journey towards carbon neutrality, having set ourselves a target to reduce our emissions by 40% come 2030. And now with the conclusion of the new agreements with Etana and NOAA, our renewable pipeline has expanded to 765 megawatts, delivering nearly the same capacity as a single Kusile unit, and thus strengthening our energy security and accelerating progress towards carbon neutrality. Naturally, this positions us as the largest contracted private renewable energy offtaker in South African mining. And with this portfolio, and come 2028, It will supply more than half of our South African energy needs. It will generate over 1 billion in annual savings and avoid 2.6 million tons of CO2 each year, a 41% reduction from our 2024 levels. At the same time, our operations, high water demand, and presence in water-strained catchments make strong water stewardship critical. Through disciplined management practices and our investment in advanced water treatment plants, we've significantly reduced potable water reliance and increased resilience, and also contributed to margins. 4 of our operations are now fully independent of municipal potable water, with our gold assets at 94% independence. Importantly, though, the water liberated through these efforts is equivalent to the needs of a mid-sized city and an essential social contribution in a water-scarce country that's currently grappling with water challenges. Our commitment to communities remains equally strong, and through the Marikana renewal process, we prioritize addressing the needs of affected families and rebuilding trust. And a key focus was closing the housing gap for families not supported by the UMCU Trust. I'm pleased to share that we delivered the final 2 of 17 houses, honoring our commitments to the widows. As a business, we remain committed to shared value with all stakeholders as we earn trust where we operate. Thank you, and handing over to you, Charles.
Thanks, Melanie. At Keliber, we are looking forward to hosting a market day in a couple of months and doing a deep dive on the operation. When you get there, you will see a really impressive build, and the team on the ground, led by Hanu Hatala, has done an incredible job in completing the build program on schedule, and where changes to spend were related to revised permit requirements late in the process. This is Sibanye's first greenfields project build, and it has been incredibly well executed. The financial investment decision for the refinery was made in November 2022. In October 2023, the scope change for the effluent treatment plant was approved, along with authorization to begin construction of the concentrator. Mechanical completion has been achieved for all components of both the concentrator and refinery, with the exception of the rotary kiln at the refinery. As you may be aware, mining activities were delayed due to postponing contract signing until the completion of the deep dive analysis in the second half of last year. Commissioning of the concentrator, crusher, conveyance system, sorting plant, and laboratory is scheduled to be completed ahead of plan. The phased approach is a direct outcome of the deep dive work conducted by the corporate technical team. The guidance is that we will produce at least 15,000 kilotons to 20,000 kilotons of spodumene this year, either for direct sale or as a feed into the refinery if approved late year and subject to market conditions. Let me unpack the stage approach in a little more detail. Stage 1, euro 783 million is the initial capital and excludes any other pre-production SRB costs. 237 kilotons of stockpile is required by year end, and to counter the limitation put on the Sajavi mining permit being capped at 540 kilotons. Stage 2 spodumene grade of greater than 5.1% is targeted to ensure a sellable product which will not incur penalties or rejection from commercial counterparties. Stage 3 refinery startup decision is conditional on a market assessment at the time. If there's a pause, we will continue with spodumene sales. Stage 4 focus on technical grade will allow the team to sort out processing issues before quality issues. The team will continue to incorporate lessons learned from other facilities. Stage 5 decision to proceed with ramp up to produce battery grade lithium. It must be noted that the qualification process for battery grade may take 6 to 9 months, which means battery grade could be commercially available, likely at the earliest in 2028. On the operational overview, it's important to note that the feasibility profiles had a number of satellite ore bodies in as well. As far back as 2023, we have kicked off mining optimization studies, which resulted in the extended life only out of the Sajavi and Rapasari pits. We intend to kick off further work on the other pits, as well as this year work on the Tusarit, which is a new pit which will lie close to Rapasari. When you are on site, you'll see that we have a strong land position with further exploration options ahead of us at the right time. And given all the exploration juniors that have pegged claims outside of our lease boundary, I have no doubt that the lithium story has legs in northern Western Finland for a very long time to come. The spike in SIB in 2008 in the graph on the lower left is mainly driven by the waste stripping for the Rapasari pit. The cost overview will be updated as we get new insights from our cost optimization and debottling studies, and certainly the team is focused on improving this picture. Here, the further optimization work is focused primarily on the following work streams: mining study work to optimize pit design, pushbacks, and stockpiling. We're targeting here a potential 10 to 15 million euro savings, and the mine to deliver a stockpile of 50 kilotons ore by 30th of June, about 1 month of inventory. As I noted, 237 kilotons to be on stockpile to ensure stable production in 2027. The concentrator study is targeting spodumene grade above 5.1% to optimize spodumene concentrate sales and boost refinery capacity. Metallurgical work on grade versus recovery is in progress. First grade recovery curves issued for mining production planning are also taking place. Cost reduction and efficiency optimization targeting a potential unit cost decrease of $1,000 per ton of lithium hydroxide has a number of components. We're reviewing the procurement for more cost savings, developing a full digital twin of the value chain to further optimize. We're studying the personnel and staffing optimization opportunities, and we're reassessing the maintenance strategy and costs post ramped up. So there's a lot of further optimization work on the go, and I'm confident that we'll start to see gains from that in the next few months. Refinery debottlenecking studies targeting higher throughput potential and overall yield improvement are also on the go. This is about increasing refining capacity by adding a magnetic separator and resolving process bottlenecks. We're looking to boost the yield 2 to 3%, recovering lithium from the effluent treatment stream, reducing ETP costs by reviewing current initiatives, and working with other third parties to support refinery commissioning and ramp-up phases. With that, thank you, and let me hand over to Charles.
Thank you, Charles. Good morning to all participants. It gives me great pleasure to share the financial results for the year ended 2025. If we start with the key highlights. Headline earnings per share for 2025 increased 281% to 244 South African cents per share. During the same period, adjusted EBITDA increased almost threefold, from 13 billion rand to just under 38 billion rand, a 189% increase. As a reminder, we have set a target of reducing gross debt by 50% from the current 2.2 billion level over the next 2 to 3 years. A through-the-cycle net gearing target of below 1 times net debt to EBITDA remains consistent with our financial policy and has served us well during periods of constrained commodity prices. If we look at our net debt to adjusted EBITDA at the end of 2025, it is down from 1.77 times at the end of 2024 to 0.59 times at the end of 2025. As a reminder, the dividend declared for 2025, as you would have heard, is 131 cents per share or 2% yield. Turning to the income statement, revenue increased by 16% and costs were down 8%. However, as highlighted on the previous slide, this translated to an increase of almost 200% in adjusted EBITDA. Noteworthy items for 2025 include the following. The loss on financial instruments of 3.8 billion rand was mainly due to the impact of the protective gold hedges that amounted to 1.7 billion rand, as well as a revaluation of the Burnstone debt. With the sharp increase in the long-term price of gold, the Burnstone debt is now expected to be fully repaid, and that meant that we had to increase this liability by 1.7 billion rand. Another big item that impacted this period, impairments for the year at the US PGM operations, Keliber and Kloof, amounted to 15.8 billion rand. The impairment at Kloof was due to the reduction in the life of mine due to the removal of isolated blocks of ground for safety reasons. The impairment at the US PGM operations and Keliber were the result of changes in economic parameters, such as long-term prices. This was partially offset by the reversal of impairments at Beatrix, Driefontein, and Burnstone due to the increase in the long-term price of gold. The transaction cost includes the $215 million or 3.6 billion rand settlement of the Appian claim. If we look at the net other costs, that benefited from credits in 2024 that were once off and did not repeat in 2025. It is important to note that taxes and royalties of 4.3 billion rand increased in proportion to our profitability. As already mentioned, a full-year dividend of 3.7 billion rand, or at the top end of the range, 35% of normalized earnings will be paid. Compared to the last dividend that we paid in 2023, this represents an increase of 146% on an absolute basis. In 2025, we had significant non-routine cash impacts that affected our financial results. These included the Appian payment and the gold hedges that was put in place in December 2024 to ensure the ongoing sustainability of our gold operations. The question that a lot of people will ask is, what would your financial results have looked like in the absence of these non-routine items? The short answer is that the money available for the three areas of distribution would have increased by 5.2 billion rand to approximately 14.6 billion rand, and each bucket would have been allocated 4.9 billion rand. However, in 2025, on a look-back basis, we did allocate more to growth as one, the revised allocation model was not in place, and two, we were finalizing the Keliber project. Importantly, for 2026, our growth capital planned, excluding DRD, is 3.7 billion rand, compared to the 9.4 billion rand that we spent in 2025. The growth capital excludes Burnstone and other projects in study phase, and as we generate more cash and earn the right to allocate more to each bucket, these will be considered. Our debt maturities remain manageable due to a well-constructed maturity profile. Gross debt was 39 billion, and less the cash on hand of 17 billion equated to net debt of 22 billion. Liquidity headroom is strong at 40 billion rand, or roughly 5.5 months of OPEX plus CAPEX. The next priority on our debt profile will be the upcoming renewal and downsizing of our 2026 675 million bond, and the target date for completion is before the end of H1 2026, and this will be subject to supportive markets. Thank you, ladies and gentlemen. I will now pass the baton to Kleantha that will discuss market performance. Thank you, Kleantha.
Thanks, Charles, and good morning, everyone. Markets were characterized by tariff uncertainty and geopolitical tensions throughout 2025 and into 2026, and this has driven the precious metals rally. Gold spot prices broke the $4,500 mark during December, up 73% since the beginning of the year, and driven again by geopolitics, wars, and a weak US dollar. Gold ETFs were up 25% year-on-year to 4,000 tons, and central bank buying continued. The platinum price rally has been driven largely by tariff uncertainty and was exacerbated by primary supply disruptions during the first half of the year. 3E recycling volumes were up 9% year-on-year, However, this is still below the pre-COVID levels, despite better prices attracting hoarded stock. The tariff uncertainty has resulted in significant platinum flows into both the US and China. Over 600,000 ounces of platinum was imported into the US in July, compared with normal levels of around 200,000 ounces. Between July and October, 1 million ounces of above normal levels moved into the US, and overall platinum imports were up over 50% year on year. NYMEX stocks quickly reached a peak of about 630,000 ounces in April, and then dropped back to 280,000 ounces in July. This as reciprocal tariffs were delayed, and then PGMs were on the list of goods not subject to tariffs. Stocks then jumped back to around 700,000 ounces in October, as the outcome of the Section 232 investigation was delayed due to the government shutdown. Since then, the outcome has been announced as negotiations, not tariffs, so uncertainty still lingers. Imports of platinum into China also increased steadily during the first half of the year, and then fell back in the second half as prices became too high. Investors and jewelry manufacturers switched into platinum as gold just became too expensive. Overall, platinum imports into China were up 7% year on year to 4.5 million ounces, supported by the launch of the platinum futures trading on the Guangzhou Futures Exchange in November. Large daily trading volumes north of 6 million ounces per day in December resulted in the GFEX having to implement restrictions on trading. Platinum demand, and along with it palladium during 2025, was largely driven by investment and speculation rather than by fundamental industrial requirements. Over the near term, we continue to forecast deficits for both platinum and palladium, while the rhodium market balance will remain close to balance. The recent rally in prices has set us a new higher base, and the heightened focus on securing critical minerals will continue to drive regional supply chains and with it price differentiation. And now moving on to lithium. The appreciation in lithium prices during Q4 was driven by China's anti-involution drive and the clampdown on primary supply in that country, as well as from better than anticipated demand from battery energy storage systems. China changed the feed-in tariff model for renewable energy mid-2025, unlocking demand for energy storage systems. Prices moved from a low $7,000 per ton levels up to just over $16,000 per ton currently. Inventory levels remain low as Cattle's lepidolite mine has yet to start producing again, and winter supply from brine production is reduced. Looking out to 2029, battery energy storage system demand is expected to grow at a 23% CAGR, while demand from battery electric vehicles will grow at a 9% CAGR. The market is expected to remain in surplus over the medium term and will start tightening from 2028 and 2029. New supply will need to be incentivized by higher prices. Looking forward to the rest of this year, we remain bullish on gold. We believe that PGM prices have reset at a higher base, but will continue to be volatile. And similarly, we believe that lithium prices will continue to be influenced by Chinese decision-making. We will therefore continue to focus on what is in our control, performance and delivery at our operations. I'll now hand back to Richard to conclude.
Thanks very much, Kleantha. And then I guess just heading into the last section to wrap up with. So I think just starting off with our guidance for 2026 and the outlook, starting off with our South African PGM operations, I think a very slight decline in terms of our production guidance in line with the overall life of mine profile that many of you will be familiar with, but no significant changes across the South African PGM operations. Guidance of the South African gold operations is slightly lower than what we achieved this year or during 2025, and that is driven largely by the reduction of output at the Kloof operations, as Richard touched on earlier. I think in terms of the US PGMs, we do see a slight increase in terms of output at the underground operations. That is coupled with the ongoing work towards reducing the overall unit costs down towards $1,000 per ounce. And associated with that, we do see an increase in some of the capital as we start making those investments. On the recycling, we have quoted our production guidance as gold equivalent ounces. So you'll see 400 to 420,000 ounces there. Please note that is gold equivalent. We produce a range of metals. But I think when looking at it on this basis, it does just demonstrate the significance of this business. Almost 500,000 equivalent gold ounces that we have built over the time of a, as we mentioned, low capital intensity, very low capital base. On Keliber, the guidance we are providing is we are anticipating producing spodumene concentrate as we ramp up the concentrator. At this stage, whether or not that goes into refinery, of course, will be dependent on the decision that is made on the commissioning of the refinery. And in terms of total costs, we are guiding towards a total expenditure of about 180 to 190 million euros. Just to unpack that briefly, approximately half of that, about 90 million euros, is the remaining project capital that was due to get spent predominantly in the first quarter and a little bit in quarter two. So that is in line with the original project capital of 780 million euros that we've shared with the market. And the balance is really the costs of as we ramp up the overall operation. At Century Zinc, this is likely to be the last full year of production out of Century Zinc, and again, largely in line with what was achieved during 2025. So just moving onto the strategy, I think as we outlined in my earlier slides, I think we've set a very solid base moving forward into 2026. The four key pillars that we have with regards to our strategy being simplification of our operating model and our portfolio, performance excellence, which I think you've heard us touching on today and unpacking around safe production, operational excellence, optimizing our resources to maximize value, and embedding sustainability in the way that we operate. Growth, which is initially focused on the value creation we believe we can drive from our existing resources and therefore unlocking organic value. And finally, a disciplined capital allocation model. By bringing these four pillars together with the base that we've set in 2025, we are certainly confident that we can unlock significant value as we move forward into 2026, irrespective of the environment that we find ourselves operating in. I think just wrapping up with the overall strategy that we shared with the market at the end of January towards creating a future-focused metals business. In the short term, our strategy is very much focused on strengthening our business fundamentals, and this will be achieved through increasing our operating margins through our operational excellence, simplifying our operating model, and ultimately simplifying our portfolio towards highest return assets and cash generative assets. I think if we're successful in this regard, we will be generating free cash through a disciplined capital allocation framework that looks at returning capital to shareholders, reducing our total gross debt, and investing in the growth and sustainability of the business, particularly unlocking our inherent resource value. We certainly see that as ultimately continuing to build our business, building our production profile, and continuing to build on our resource stewardship model across primary mining, secondary mining, and recycling. So ladies and gentlemen, I think in conclusion, once again, thank you for joining us today. To try and sum up in 3 quick points, I think where we are sitting today as a business, I think we've had a solid operational output in 2025, and I think we're well positioned moving into 2026 to unlock the significant value that we have within our portfolio. I think we have seen a noisy set of financials, but looking through that, there is some real financial stability in the company. We've reduced our gearing significantly, and certainly at the current commodity prices that we are experiencing and the operational output that we are achieving, we look forward to some significant cash flow as we move forward. And then I think we finally have a resilient and a disciplined strategy This is a strategy that is independent of the external environment and positions us for long-term themes which we see underpinning growth within the commodities market. So just in terms of way forward, as we did share with you at the end of January, we launched our strategy on the 29th of January. Today we have shared our results, but as we move forward at the end of April, we will be looking to have a 2-day capital markets day focused specifically on our international operations. That will be a webcast as well as an in-person visit in Finland at our Keliber operations, but we'll also cover both US recycling and Australian operations. And then towards the end of June, another 2-day capital markets day in South Africa, specifically focused on our gold and PGM operations. So we look forward to engaging with you and getting those invitations out. And thank you once again for joining us today. And of course, we're happy to take any questions you may have. Thank you very much, and over to you, James.